You are watching Good Policy, Bad Policy, where we review life insurance contracts or illustrations to find out, is it a good policy or a bad policy? Today I've got an interesting one, came in for review. It's on a female, age 64, non-tobacco rating. It's an index universal life insurance policy. It has a premium that is just a one-time premium of $381,000, but that's it. The initial death benefit is $858,603. Let's take a look at the tabular detail. When you're looking at a tabular detail to find out if a policy is a good policy or a bad policy, you want to look at the guaranteed values. The guaranteed values on this illustration are anything below here. Guaranteed values are exactly that. They're guaranteed to be there if you pay your premium. This is an index universal life insurance illustration, age 64 female, non-tobacco. That's a standard health rating. And you can see the $381,000 of premium going in right here, all in year one in this case. Total distributions column, this is something to pay attention to on this illustration, is about $40,000 a year they're taking out as a variable interest rate loan. That's what VL stands for. Starting in year 6 and then continuing on. You can see $40,000 a year going from there. Account value is the amount of money that's indexed for this policyholder's benefit if they buy this policy. Net cash surrender value is what you would get if you own this policy for a bit and then surrendered it in any of these years. You can also borrow this money from your account if you want to, and you do that at a variable loan interest rate, which is where that's coming from. You can see right here when they start taking $40,000 a year, then the surrender value starts decreasing. That's where that money's coming from. Okay, and then over here's the death benefit. Starts out $858,603 in the first year. All right, so as we look at the guaranteed values in this policy, we see something kind of change right here. Everything goes to zero. That's an issue. We want to look at this area. So 12 years into the policy, when this lady would be 75, about to turn 76, all the guarantees go away in the policy. That could be an issue. We'll need to look at that closer. Why is this happening? The reason it's happening is because this 2.5% right here is not keeping up well enough on this once you subtract expenses and fees or anything like that to be able to pay the premium on the increasing cost of renewable term insurance. In an IUL policy, the death benefit comes from renewable term insurance. Every time that term insurance renews, it gets more expensive. If this account value is growing fast enough, then it can cover the increasing cost of insurance. If it's not, then it won't, and your insurance will go away. That's what we see happening right here. You can see not only does the insurance coverage go away, but also the surrender value. The policy is worth nothing at that point. All right, so let's take a tally of how much she actually is out for the policy at this point. She paid in $381,000 total. And then from year 6 to 10, she got $198, let's just call that $200,000 of loan from the policy. Then she got about another $40,000 in year 11. And she's not going to get all of that. In fact, she may get none of that, but let's just throw it in there for good measure. So we'll say $246,000 she's been able to distribute from this policy and have come back in at sort of as supplemental income, we'll say. So let's do the math on that. $381,000 for funding, and then $246,000, subtract that. The policy has cost her $135,000 at this point right here. And then it goes to be worth nothing. So if she dies any time within here, you can see that death benefit does offer a good return on the $381,000, and that would be a good investment for her family. But she's not going to guarantee that she dies in here. In fact, the average lifespan for a lady in the U.S. today is going to be in her 80s somewhere. She's not even in her 80s. She's just halfway through her 70s by the time this policy becomes worthless. So we could expect some sort of tragic or unexpected accident of some kind that takes her if she's going to die in this window here. Okay, not pleasant. If she lives a day too late, then she's paid $135,000 for nothing. Let's clear this ink real quick and roll down the page and just see what happens later on. You can see everything is a zero in the guaranteed values. The time when she's probably likely to die, like upper 80s, 85 to 90, still everything is zero. So how do they even sell bad policies like this? This is a bad policy. It lies over here in this non-guaranteed column. This non-guaranteed assumed value, you can see that 6.46% is higher than 2.5. And then they have a mid ground here too. So 3.5% you can see gets her like another few years. Remember, this is not guarantees. This is just estimate. So they estimate it'll get her another year out of it. Okay. If it's a 6.46, then they say, oh my goodness, look at you living large. We got $40,000 coming in a year as distribution. These are all variable loans, variable interest rate loans. Okay. Until age 90, then they stop that, probably because of what the cash value is doing, continues to decrease. See the net cash surrender value here keeps decreasing. So they stop taking distributions from the policy and they start letting the cash build again at this indexed rate. And it just goes haywire at this point. It goes crazy big. These numbers aren't even realistic, but when you're thinking out this far in advance, and an insurance agent just takes you to this section of numbers here and says, oh my goodness, look, when you're 91, you'll have taken $874,000 of distribution from this policy. All you'll have paid in is still $381. And if you die when you are, 90 and you've taken that amount of income, look, your heirs still get $205,000. And they get this $116 of leftover cash value. All this for only $381,000. If you live longer, then let's say you die at age 100, then you get $787,000 in cash value and $787,000 in death benefit, and you've taken $874,000. I mean, the numbers just get ridiculous at this point, and they are ridiculous because we've reviewed a lot of IUL contracts, and they never do this. Okay, most of them are on these numbers, somewhere in between these numbers, which still isn't that good. It's a bad one. Well, that was a bit of a joke of a policy. Out of curiosity, let's see what we can illustrate, and if we can illustrate something that'll be any better for this lady. All right, here's what we were able to do. Female, age 64, non-tobacco, nothing changed there. I'm using a different product. I'm using a whole life policy because it's going to make this into a better policy for her. All right, I want to point out something different in the way these policies were funded. This one is funded over 10 years instead of all in the first year, like the bad policy was, but same amount of money. So cumulative premium on both of these policies is going to be the exact same, $381,000. Let's look at the guaranteed values on this tabular detail page. Guaranteed values, remember, are what tell us whether a policy is good or bad. Non-guaranteed values are hypothetical. They may be there, they may not. If the guaranteed values are good, though, the policy is good. This policy, the bad policy, runs out of guarantees after year 11. So year 11 is really the last year we have to compare with anything. So let's do apples to apples and compare in year 11 on this new policy as well and see what the difference is. Total cost for the bad policy over here was $381,000 in cumulative premium, but remember, they were taking out distributions as well. So we're rounding that number up to $200,000, that number up to $40,000, and we're leaving that number at $6,000. She's probably not going to get that, but we'll just give it to her just for good measure. We'll call it $246, the cost on this. Subtract that from $381, and we get that $135 $135,000 of cost. Let's do similar on this policy over here. Total cost was $381,000. Since we didn't take any distributions from this policy, we can just take that number there and subtract it from that one. Let me do that right now. And 381 in cumulative premiums, and subtract 367, 272. And the total cost for this policy at this point is $13,728. Let's call that $14,000 for ease. Okay? $135,000 versus $14,000. Death benefit in this policy in year 11 is $572. Death benefit in year 11 in this policy is $594. Very similar. You get almost $20,000, like $18,000 more in this policy over here. Okay. Something else that I like to look for in the policy is, does the cash value ever equal what she's paid in premiums total or exceed it? So if we go down here looking for about $380,000, year 13 is the lucky year. Look at that. Year 13, when she's 77 years old, if she decided, you know what, I don't want this policy anymore, she could walk away with $386,000, which is roughly, about $5,000 more than she paid for this thing. And she's actually made money on her life insurance. That's kind of weird. Okay. But you go on, and let's just look at year 20. Again, the cumulative premium, $381,000. She has $450,000 for 21. Remember, life expectancy for a lady in America today is in the 80s somewhere. Let's take mid-80s here. Yes, she still has a death benefit if she were going to die about that time. She also has a lot of cash value, way more than she ever paid for this product. Remember, these are still under guaranteed values. This is a good policy. And you know what? The crazy thing is, a lot of people think that they're too old for life insurance when they're in their 60s. You can see that, no, not at all. This policy is doing great for her. It takes a little while to get there, like 13 years to come ahead, but then it's all ahead from there. Her insurance, this $500,000 here, is basically costing her nothing. That is pretty amazing. Okay? Even if we compare non-guaranteed values where they're doing a little bit better in here, this still knocks the socks off. This is a good policy. Now, we looked at the non-guaranteed values on the other one just for kicks. Let's look at the non-guaranteed values on this one too. I'll clear this ink off of here. And you can see, still got the same cash outlay. The only difference in this column is the estimated dividend. And I have that set to buy more death benefit. So you'll see this death benefit creeping up there over time. You can see these numbers aren't quite as outrageous as they were on that other IUL illustration. That's because companies have been paying dividends for many, many years, and so they're better able to estimate the dividends. We see whole life insurance policies that are paying dividends performing a lot closer to the dividend than we do see IULs performing close to their non-guaranteeds. Now, there are cases where we've seen whole life insurance policies pay next to nothing as their dividend too, which is the reason why we always have to look at the guaranteed numbers. Thanks for joining me today. If you have any questions about these, make sure that you hit the comments below. Ask your questions. I'll check the comments. I'll try and get back with you so you get an answer to your question. Well, there you have it. We were able to knock the socks off that bad policy. So the policy we reviewed today was definitely a bad policy, but we were able to make a good policy instead. If you have a life insurance policy that you currently own and you're not sure if it's a good policy, bad policy, or you have a life insurance proposal that you're thinking about getting and you want to make sure it's a good policy, then make sure that you contact us to get the independent insurance review, and we'll do this for your policy. The link is in the description. We always protect your privacy. Upload your policy if you would like an insurance review.